Okay, great. Welcome, everyone. Welcome to this month's webinar. Today's the 9th, and speaking from a very sunny, hot Putney Bridge, London, and today is going to be focused on how to identify huge market moves weeks in advance. Now, this is something which is key to set and forget trading, which is something I've grown into over the years of trading. Just a bit of background, I've been trading since 2007, can honestly say I've made every single mistake in the book several times over and gravitated eventually towards a style of trading which meant that I could simply enjoy life, enjoy hobbies, interests, pursuits, people, friends, without really having to watch the screen all day. Okay, so this is essentially hinging on set and forget price action based trading, which works on currencies, stocks, commodities, you name it, it works. And so without further ado, I just want to get your eyes on this disclaimer very briefly, and we can start. All right, so a key cornerstone to anticipating big moves, days, weeks, months in advance, hinges down to your map of the markets. And a large part of that is essentially your ability to identify key turning points or key levels, okay? Key levels in the market are of no coincidence. They essentially represent where banks, institutions, the bigger players in the market have had or could potentially continue to have orders, all right? And this is something we want to have in our arsenal. Horizontal levels are very important. They have memory, and certainly in range-bound markets where we have multi-highs and lows, they're very important to us, and we can really get into a big potential move very early on without having to wait for all these confirmations. Because sometimes, if you're a price action based trader, for example, if you trade bearish or bullish pin bar reversals, sometimes when the market gets to a key level, the market will just move off the level without a care in the world, and it will leave you behind. Okay, so this is why market mapping is very important. And in this webinar, I'm going to talk to you about what a market map is, why we do it, and how we do it. Okay, so it's going to be very hands-on, and we're going to apply it to the market today. I know we've got some examples in the presentation, but there's no substitute for the current market. I mean, you know, it's real-time learning. It's very easy to pick picture-perfect examples from the past, but as I said, we want to apply it to the present. Okay, so what is a market map? It's essentially a chart. Could be of anything. It could be a currency pair, stock of any entity. It could be a UK, US stock on the DAX, the CAC, Germany and France, respectively. It could be a commodity. But essentially, regardless of what it is, it's a process whereby we are able to analyze or identify key levels of support and resistance on the monthly, weekly, and daily time frame. Okay, and this is something which we like to do. We like to start at the higher time frames, for example the monthly, and then churn down to the weekly and then the daily, because it's fair enough to say that market structure is deeply embedded. Certainly the higher the time frame, the stronger it's likely to be. Okay, so this is what we are doing when we're drawing our market map. The higher time frames have bigger governing power over the smaller time frames. This is why I personally trade the daily and the weekly, purely because if it's a trending market, there's strength in a trend. If it's a range-bound market, there's strength in the range. If it's anything smaller than like the hourly, for example, you're susceptible to intraday spikes, unexplained news announcements, or just horrible noise in the market, which can really cost us a lot of money if we're scalping, dare I say. All right, so essential to take advantage, or not to even take advantage, but identify key levels of support and resistance on the weekly and monthly, because once we've got those levels in, all we need to do is wait for the market to come to us. That's the beauty of it. And this is true in so many different aspects of life. Waiting for the opportunity to come to us once you've got our plan. Any of you who've read The Art of War by Sun Tzu, the war is won before it's begun as a result of meticulous planning from the outset. All right, so not only are we drawing a market map here, thanks to the monthly, weekly, and daily, we're also identifying market structure and a level of predictability within the chaos and randomness where anything can happen at any time. Of course, we can get it wrong sometimes, but as technical traders, we go with the probabilities, even in the face of adversity sometime. The market is called a market for a reason, and there's nothing more tedious than we've got a decent trade idea based on, say for example, shorting the FTSE at a multi-year high, say last year. I know it's not a currency pair, but it doesn't matter, it's just an example. And you're always going to get someone to say, well, the FTSE is going up, it's going to breach 7,000. Well, you know, it might do that, but, you know, who knows for sure? Okay, so this is why we always pick high reward to risk setups off the back of this. Okay, so when we're right, we can be proven very right and potentially be rewarded very handsomely for it. If we're wrong, we only lose a small amount. Okay, so we embrace the positives and the negatives through risk management. Okay, so why do we draw a market map? Well, I'm pretty sure I've covered this already, but repetition, I found through mentoring is the key to success. So I'll tell you again, I guess. We can essentially identify key turning points in the market way in advance of the market reaching them. So we're looking at the monthly, a very strong level of support or resistance, which has formed over the course of 5 years, 10 years, even 20 years. For example, Aussie New Zealand, which is something I'm going to show to you when you get to the actual charts, the live charts. People who essentially draw the market map and identify the 25-year level of support would have done very well last year if we're just simply buying at this this multi-year low, a level which hasn't been breached for 25 years. Okay, so another advantage to pre-planning levels of support resistance from the outset is so that you can identify the price coming to you beforehand so that your vision or your perception is not clouded and you can just make an informed decision as of when the market gets to your level in advance. Okay, so set and forget trading. Those of us who trade the weekly and the daily, we have the blessing of knowing what to do days, weeks, even months in advance of the market getting there. And this is what I call a well-executed plan. Rather than being in the heat of the moment and turning on your computer and thinking, looking at the hourly chart, oh goodness, there's a trade set up there. You trade it and then you think, oh God, I didn't see this level of resistance in the way. Damn. I'm sure a number of you have been there. I certainly have. So it's all good. We learn from our mistakes. Sometimes some of you decide to do it the hard way. I certainly did. But then I eventually decided to get educated about it. Okay, so in order to do this, as I'm sure all of you are probably deduced by now, what we want to do is we want to look at the daily, weekly, and monthly, and we want to identify both hard and soft levels of support and resistance. It's best, I know a number of you might wonder, okay, which way do you start? I would say start on the monthly, draw your levels of support and resistance on the monthly, then the weekly, and then the daily time frame. Because what you have the advantage of doing then is simply drawing the level on the monthly, and then once you get down to the weekly, you'll see that the level's already drawn there, so the work's already been done for you. And when you get down to the daily, you'll find levels which you might not even see on the weekly or the monthly. Okay, so that's the beauty of it. So here we go. This is a pound CAD on the monthly. We can see it ever since 1994. Can you remember what you were doing then? Well, the market has memory, and we can see that since 2005 we've been trending downwards on the monthly time frame. But certainly from 2010 and 2012, which this chart was taken from, we can see that we've been consolidating. And as we're in a general downward trend here, it will be safe to say that we've got a key level of monthly resistance and support here. Let's go down to weekly. And when we get down to the weekly, we can see levels which we wouldn't have seen on the monthly. So there we go. And some of you more astute people who pay more attention to the detail will, and I hope you do this, essentially draw the levels of different timeframes in different colors. So the monthly level, just for example's sake here, I've colored orange, the weekly level blue, and as you'll come to see when we get down to the daily, I've colored it in black. Okay, so you've got a real kind of like measure of perspective there. Okay, so orange is the stronger level, being the monthly, the weekly is the second strongest, being the blue, and the daily being relatively strong, not as strong as the weekly or the monthly, being black. All right, and you can see that in this well-established range here, I mean, you don't really have to be a rocket scientist to deduce that if price does come down to this horizontal level here, this monthly level of support, that it's likely, based on what price has done before, that it's going to go up again. But had we not had this level drawn in a nice, bright, obvious-looking color, then it's likely that certainly when people are getting carried away with the smaller time frames, which is something a lot of people do when they're new to trading, that they wouldn't have spotted it. And they might have decided to have taken a short on the hourly if the market comes down to here, only to their horror to realize that there's a huge level of monthly support in the way. And this is something a lot of intraday traders get wrong. Okay, they place their trades in the way of key levels of support and resistance, essentially the market map on the monthly, weekly, and daily levels. Okay, so just to give you another example, we've got we moved on to another example, but you can see here on the monthly, weekly, and daily, anything above the price is a potential sell level, like here. This is potential sell level on the daily time frame, then we've got the potential sell level on the weekly, and then a potential sell level on the monthly here. Anything below the price is a potential buy level. And of course, as we deduced with looking across the monthly, weekly, and daily time frame, we've got ascending strength in the levels of support here. So obviously, price does come down to this level. I'd far rather get long on this monthly level of support than certainly the daily. The higher the time frame, the stronger it is, especially in a range-bound market. And this is absolutely fantastic in order to get. And you know, pound CAD, I know it's gone a long way since then, but there are certainly other range-bound markets I'm going to draw your attention to. Let's move on. Here's another example. Here we go. So Euro New Zealand, we can see here that on the monthly, we've drawn our monthly levels in. I know they span back all the way back to 2000. You know, that's quite a long way away, but still, it doesn't matter. Levels have memory. That's the key factor, which a lot of people are very happy to forget here. And then we go down to the weekly. We can see here we've got downward trending markets, ascending wedge, and we can put our levels of support and resistance, horizontals, as well as trend lines. Trendline resistance and trendline support, and these are typically levels you wouldn't see on the monthly time frame, but we do on the weekly. So we color them in the color blue to reflect the weekly down to the daily, and this is where the shorter term action happens. And as I said to you before, the longer the time frame, sorry, the higher the time frame, the stronger it's likely to be. Okay, so we've got our new levels drawn in for the daily in black. So you can see here that orange is the stronger level, blue intermediate, and black the weakest, but they're all valid. Okay, so I would like to apply this now to the actual charts. Let's get E signal up. There we go. And unfortunately, I had a bit of a power outage in Putney Bridge earlier today, which wasn't very convenient. So unfortunately, for the interest of time, I'm not going to color in the different levels. But what I'm going to do is just give you a crash course in applying them. So say, for example, we've got pound New Zealand here. There we go. This is one of my favorites, ironically. A lot of people think I'm bonkers for trading it because of the huge spread. And I'm not going to lie to you, the spread is pretty enormous compared to the more liquid currency pairs like euro, dollar, or cable. But if you're going for these huge moves on the weekly or the daily, it doesn't really matter. So as you can see here, we've got the monthly, and you can see that, okay, got a horizontal level of resistance here. Fantastic. That's nice and straightforward. And potentially a level of support here. Got two tests. But we've got it here as well. Let's just squeeze this in. There we go. Level of potential resistance if price breaks to the upside here. So let's just move down to the weekly now. There we go. I'm sure on the weekly we're going to see levels which we weren't able to see on the monthly. So we can see this potential level here at 1900. So we paste that in. And then we can see this potential level here. So paste that in. And you know, there's a real knack to doing this. The more often you do this and identify these horizontal levels, the easier it becomes. I know a lot of people kind of ask me, well, how long does it take to spot these levels and how can you do it so quickly? Well, it comes with practice. I've been doing this for about 7-8 years now, and it really did just come into its own. It's like, well, I know it's a cliche, but riding a bike, for example, the more you do it every day, or skiing down a piste, certainly if you're doing it every day since the year of like 5 years old, you're going to be coining those black runs after a while. So there we go. We're down to the daily, last and not least, after the weekly. And this is where things get a little bit more chaotic. Ugh, look at that. It looks horrible, doesn't it? But even though it looks chaotic on the daily, we can see, okay, there are not really many more levels on the daily here. We've already got them in. And as I said, this is why I start this analysis on the monthly and the weekly, purely because if you start on the monthly and the weekly, a lot of the time when you go down to the daily, by the time you get down to the daily, you'll find that the levels are already there for you. So, lo and behold, the opportunity, based on certainly one of our supply and demand strategies, was to simply sell at this horizontal level here at 2 spot 100. And this is a level which hasn't been broken, well, for quite some time. Since 2011. All right, so key level of supply or resistance, some of you might see it as, or even a ceiling. Whatever you call it, it's the same thing. It's a barrier in the way of price going upwards. So this is a key level to essentially have on your market map, okay? And even because it hasn't broken out of its range yet. I know we've got the elections coming up, and I can almost guarantee that if David Cameron gets in, then Tory party, the markets will like that more than if someone like Ed Miliband gets in. So, and I don't say that lightly, by the way. Anyway, let's not talk about politics. So yeah, it's always good to have this level in the mix, or these strong levels in the mix, because if it wasn't for anything as significant as an election and price did trickle up this level, then it would be a fantastic sell opportunity. And we don't get these opportunities very often, but when they do occur, they can potentially be very lucrative. Even if you had a sell order on the level itself or just below it, and a stop loss of, say, 100 to 150 pips, and you're targeting, say, the midpoint of it, you'd say there's 1,589 pips potential profit there at the midpoint of this long-term range. That's not bad, really, is it? I mean, that's about 10 to 1. But the thing is, a lot of people in their insatiable appetite to get in the market and get a slice of the action as quickly as possible, what happens is that they all too often they're not prepared to wait for these trades, and this level hasn't broken yet. So guess what? This level is going to still be on my chart until it does break. And even if price does decide to break this level, if David Cameron, say for example, does get in and the Tories have a landslide victory, kind of unlikely, but if they do, then I can reasonably conclude that the British pound will strengthen immediately off the back of that, and this level will be broken. If it does break, then what I'll look to do then is see if it's a false breakout firstly. If it's been confirmed as a continuation after the breakout, then I'll simply wait for the pullback and wait for this horizontal level of resistance to test as support prior to a continuation to the upside. But for now, it looks good as a sell level. And lo and behold, if we go down to this weekly horizontal level here at 1900, looks like a fantastic buy level. Okay, so when you're doing a market map of the monthly, weekly, and daily time frames, it really does make sense to have in your mind that if price is above, then it's a potential buy level. If price is below it, then it's a potential sell level. All right, so and this is the daily chart, just to remind you, if it does look a little bit chaotic and jagged and clustered, then I can guarantee you that if you go up to the weekly or higher time frame, you will always get a lot more clarity on it. And that's a beautiful thing. That's what we want as traders. We want to be objective in our analysis, and we want to just keep things simple rather than complicated. A lot of people, again, when they're new to trading, they have this kind of misconception that the more complicated the strategy is, the better it is. That's not how it is. It's not how it's meant to be. And if it was like that, I wouldn't be trading. I've got a very simple mind, and I like to keep things simple, as simple as possible. And it's kind of like the old cliche, if any of you work in sales, a confused mind never buys. Well, certainly if you're confused about a trade setup in the market, then you shouldn't trade it if you don't understand the logic behind it, or indeed what you're doing. If you're following someone blindly, which hopefully you would never do, because, of course, it's always going to be your fault if they get it wrong or if they get it right. But so that's pound New Zealand. Let's move on to another currency pair, because I could talk about this until dusk sets in London, and I'm pretty sure most of you have other things, more pressing things to be doing rather than listen to me talking about pound New Zealand. So let's move on to the monthly on this old chestnut. I know I've mentioned this before, but hey, what? I'm going to talk to you about it again. This is Aussie New Zealand, this cross-currency pair. You can see here on the monthly, ever since 1994, when the Tories were last back in power, that we've got these key levels of resistance on the monthly, great levels, fantastic levels. Certainly the fourth test here, although back at the end of 2013, represented a great buying opportunity, and certainly a number of our clients took it long. And now we've had the break of the level here. But you can see that if you risk manage and you essentially go for high reward to risk setups, if you get it wrong, you lose a small amount, like those people who took it long earlier this year. Those people who took it long last year, or the year before last, would have made a lot more than they would have lost had they got it wrong the second time round, if that makes sense. So, irrespective of what happened earlier this year and this level breaking, this did look like a fantastic monthly level of support to buy. And if and when price action comes up to this level here, you might be waiting another 5-10 years, but this would be a fantastic sell level on the monthly. I know a number of you are probably thinking, well, we don't want to trade the monthly, Jesus, life's too short. And of course, I completely understand. But if we do get onto the weekly, you'll see some levels there which we can also take advantage of, given they're not that obvious in comparison to pound New Zealand. So here we go. We've got a level here. Let me just draw this in on the weekly time frame. There we go. level right here, just about. It's not very clear. I mean, if you don't see the level obviously or clearly, then there's absolutely no shame in just moving on and just stepping away. We've got a level here. We've got resistance, resistance turning into support, and it could be a potential level. Again, if price comes up to it, could potentially be a level obscuring price, and it coincides with the midpoint of the range as well. So that's that is significant. But anyway, let's move down to the daily. Excuse me. So on the daily, there's not really much to it, to be honest with you. I mean, you can see here an obvious downward trend on the daily, and you don't have to be a master of geometry or anything, trigonometry, or even physics to work this one out, making key lower highs and lower lows. So even though we're not in a range-bound market, we know that we're trending downwards, and it makes sense in this instance to simply sell the rally and go with the trend. I mean, this has been trending downwards for a long time, since November, but from a more macro perspective, bigger time frame perspective, ever since 2012. All right, so I'm going to show you the FTSE very quickly. I know it's an index, but please just imagine it's a currency pair. I mean, price action behaves in exactly the same way, whether it's a currency pair. I mean, the price action all kind of relates down to our chromosomes and our behavior in the markets, and there's always this history does repeat itself. It really does. And you read any book on the Wall Street crash, then you'll gauge that for yourselves. But it's the same with trading. History repeats itself, and this is what we're looking for: recurring nuances and probabilities in the market. So let's start off on the monthly. Here we go. Notwithstanding the recent announcement from the ECB and the money printing, which of course helped the FTSE reach that level. But before that, we had a fantastic level of resistance to sell off the back of here. Fantastic level. You can see we have very recently breached an all-time high, last seen in 2000 and there we go. So at this point here, it's a huge level of resistance in the way. And it will make sense to simply, as Warren Buffett would say, be greedy when people are fearful, or fearful when people are greedy. So we've got a question here. What wording is opposite to sell the rally? Well, it's buying the dip. Buy the dip. Okay, so I hope that answers your question. Write that one down, if you will. It's a bit of a cliche, but it's very true, and it will continue to be true no matter what trending market you're kind of trading. But anyway, here this huge level, and we're only aware of it if we looked at the monthly. If we were looking at the daily, we would not have any idea really of the fact that we were looking back at an all-time high. We would just think, okay, this is a level of resistance, and the way it's eventually going to be breaking because it's tested so many times. But if we look back on the monthly, you would see that it's an all-time high. It's come off an all-time high earlier last year and the year before, and this is very significant for taking advantage of a supply-based sell trade. And these are extremely lucrative. I mean, reversals, a lot of the time they do fail, but the ones that really do play out are the ones that do phenomenally well. And I know it's different to a lot of the psychology out there, if you see what I mean. Counterintuitive sometimes. I mean, a very safe way of trading is with the trend. Okay, and I know a lot of you might be psychologically opposed to going against that, but where we see a multi-year high or low, this is where we can be excited and potentially take advantage of a reversal. And you know, you have the safety of probability in trending markets, which is great, but the reward is not nearly as high when the trades go the right way. That's the beauty of it. Okay, so we go down to the weekly here on the FTSE. You can see. There we go. We'll look for these other levels of support and resistance. There we go. And these are the levels which wouldn't be visible to us on the monthly, but they're there and they're significant. And certainly if we've got the weekly levels in, then if we're trading the daily time frame, they would be significant to us because, of course, the weekly horizontal levels are going to be a lot more robust than the daily levels. Okay, so that's all the weeklies I can see in the way for now. Let's go down to the daily. And then we'll be able to take advantage of levels, if we can find them, which might not be visible to us on the weekly or the monthly. Well, to be honest, to be honest with you, I'm struggling here. There aren't really that many on the daily, not many clean ones. No, so that's the thing. We've already done the hard work thanks to analysing the monthly and the weekly here. And this is the beauty of it. If you start high and you scale down, you churn down, as they call it, to the smaller time frames, you'll find that the levels will already be there for you. So I always kind of encourage my clients to do this, and this is to simply start on the monthly, weekly, and daily. And once you do that, you'll find a lot of the time that your analysis is already done, and you don't really have to do any more technical analysis for quite some time. But you do still need to keep a rough eye on it. Okay, so let's move on. Excuse me. I'm just going to talk to you about Euro GBP now. This is a cross pair which has been very dear to us and our trading accounts over the past 5 years. If you look on the monthly, there we go. You can see here that we're in a downward trend on the monthly, making lower highs and lower lows, especially recently. We could draw on a trend line in to match up as many points as possible. There we have it. And then we can see if that correlates with, okay, there we go, the bottom side of a channel. I haven't got any horizontal levels in here, but at least we've got trend line resistance and trend line support here. Fibonacci, someone's asked, best time frame to apply Fibonacci. Well, I'd recommend doing it on, start off with the hard time frames, then work down to the weekly. But ultimately, you want to be applying it to the time frame you're actually trading off. Okay, so take a look at Euro GBP. We've started off on the monthly. We've got this trend downward sloping channel, just about. Now let's go down to the weekly. There we've got lower highs and lower lows still. We haven't got any horizontal levels, which is absolutely fine. But what we can see here is we've got more of a perspective that if price action does come all the way up to this point here, and it could correlate Fibonacci, Fibonacci level if it does, fantastic if it does, but we've been waiting quite some time for this to happen. I remember going short all the way here back in 2013, and to my horror, we had to wait quite some time to realize some profits, and it came back, made a lower high before coming all the way back down again. And I wish I could say I was in this trade all the way down, all the way to the bottom, but we weren't. Certainly rollover costs can add up if you're in a trade for a couple of years. But certainly this is an example, and this market mapping you can apply to any time frame, by the way. So for example, if you trade the 4-hourly chart, then you'd analyze the weekly, daily, then the 4-hourly. You know, it's as simple as that. If you look at the hourly chart, then you can look at the timeframes above the hourly. For example, the daily, the 4-hourly, and then the hourly. Okay, so this is the fact of the matter. So we're just waiting for Euro GBP. We're waiting for it to come back to this horizontal level here, which represents getting Fibonacci out on the last swing high. All the way down here, the 382 Fibonacci retracement, which is a bona fide shallow retracement on the weekly time frame. If we look at the daily, though, let's see if we've got any opportunities on the daily for the meantime. Can we identify any levels on the daily? Well, not really. There's nothing really on the daily that we haven't seen already on the weekly and the monthly. Okay, which again is the bonus because we've already done the hard work for us, so we don't need to be doing it again. By virtue of the fact we're starting on the monthly and then going down to the weekly and drawing our levels on both. Respectively, it means that we don't really, a lot of the time, have to worry about the daily. Let's go back. Let's look at another one. I'll tell you what, I'm going to ask you to pick one for me, and first one to suggest a currency pair, provided I've got it on my chart, that is. Anyone want me to cover any currency in particular? Feel free to write it in that chat box. Okay, euro dollar, that's makes perfect sense to me. Let's start with euro dollar. And that will lead us up to the top of the hour. Okay, so we can see here in the monthly, well, dare I say, looking at the monthly, I know this contradicts any kind of news announcement or analysis out there. We've got higher highs and higher lows, like so, in an upward trend on the monthly, but Let's see what the weekly is saying. Let's look for some key levels first. On the monthly, we've got this horizontal level at 1.200. Haven't got one here quite. 100. Not quite. Squeeze it in a little bit more. There we go. We've got one here. Just an advance of 0.900. Parity. Well, we can expect the psychological number parity. We've had test of support before, and parity is a very good psychological number. So that's the monthly. We can say we're in an upward trend on the monthly, but you know what? Let's draw this trend line in and see how long it lasts. And you know, I'm not a great fan of trend lines because they're very subjective. You know, if you draw a trend line and compare it to your neighbors, you'll find a bit of a difference. Okay, so here we go. There's our trend line, and this is something we would not see on the lower time frames. Once again, very important. So if you're, for example, you're an intraday trader and you're on the hourly, and you're thinking you're going short round about here, and you're in a short trade, of course the market's going to react to a trend line as well established at this. I mean, the market's on the monthly is still making higher highs and higher lows unless we have more negative data coming out of Europe. I mean, can it get any worse? I can't really think it can, to be honest with you. So here we go. On the weekly, let's look for those levels that aren't visible to us on the monthly or the daily. I can't really squeeze any more data on my chart. There we go. Not really, actually, funnily enough. I'm just about to get one here. There we go, in there. But nothing else. Let's look on the daily. And as I said, if you don't find the levels obvious, then don't bother, don't waste your time. Yeah, it's a simple rule, which I have to remind my students time and time again, but if it doesn't look obvious, don't bother. On the daily as well, we can just see that this has gone like a hot knife through butter ever since May last year. It's just gone down and down and down. And we did have, well, the market did try to make a double bottom at this, what is essentially the trend line bounce on the monthly, but it failed to break the neckline. Now it's come all the way down again, and I'm sure this will just represent a lower high in what is essentially a long-term downtrend. It'd be interesting to see, let's do a target shooter here. Okay, it matches with parity, absolutely. This is an ABCD pattern here. And we've got A to B equals C to D. So that's, you know, a good target shooter. I mean, parity, I would look to take profit just above parity if you're looking to take advantage of this trade. On the weekly, let's see if we've got a bearish pin bar reversal on the weekly. No, we didn't have anything on the weekly, unfortunately. Just a bit of a chaotic mess. But yeah, so that's euro dollar. And hopefully that really kind of like hammers home how important it is really just to have these levels mapped on in advance, because without these levels on the governing timeframes, the higher order timeframes, you won't really have much idea as to what's going to be in the way of your trade if you're in on, say, the hourly or 4 hourly or even the 15-minute. So that's the fact of the matter. Let's look at cable. Let's go down to the up to the monthly. There we go. So you've got some horizontal levels here, here, here. You know, don't worry too much. Thousands of pips away from the current market. I would say just keep it relative to where the market really is. Okay, because it can take years to travel all the way down to here. So we've done the monthly. We can't really see any other levels, or I certainly can't. Oh yeah, here we go. There we have it. Then we go down to the daily. My apologies, the weekly, sorry. We've just done the monthly, now the weekly. I can't really see any other levels on the weekly, which we haven't covered on the monthly already. There we go, there's one here, just about. Yeah, that passes as a level. We don't have anything else. No, we don't have anything else. So let's go down to the daily. And the daily, you can see comparative to the weekly and the monthly is pretty choppy. And okay, we can see some horizontal levels right here. There we go, horizontal level, horizontal level. So you can see it always does pay to look at the 3 different timeframes. All right, so when we're at any of these key levels of support and resistance, which have been unbroken for years or months or decades, then we could think about potentially going long or short, depending on whether it's a level of support or resistance. And this is essentially how we can pinpoint key turning points months or weeks in advance of the market turning, just simply by having key levels of support and resistance already mapped on our chart before price actually gets to it. And of course, unless it's off the back of some end-of-the-world news, like imagine if Ed Miliband got into power in London, then of course, well, I would probably want to throw myself off a 20-foot building. Just kidding. But no, the market, the FTSE would not like that very much, I can imagine. And nor I don't think would cable, or the pound versus the US dollar, should I say. But aside from that, when we've got markets just trickling into levels, multi-year highs or multi-year lows, which are founded on a weekly and on a monthly, then we can reasonably expect there to be a decent kind of reaction. And this is what a lot of our reversal strategies hinge on, multi-year highs and lows, and how to really get into a big move before they've actually started. Okay, so very important stuff. And a lot of people choose to forget about this because it means waiting and staying out of the market. But a lot of people also forget that it's the trades that you don't take are the ones that make you the money. So this is why it does pay to be patient and disciplined. I know it's a bit of a cliche, and I know a number of you are probably sick to death of me saying it, but I'd honestly, enthusiastically recommend to you that patience and discipline does make a trader successful long term. It preserves your capital for those opportunities when and where you really do have high reward to risk and probability behind you. I'm just going to show you this trade, which we're currently in. I know a number of you are asking. We're currently in a pound New Zealand short based on this level of resistance, on the daily level of resistance. And we took this as what we call a ring high setup. I think maybe even there's a Steve Emmett in the room. I don't know if you're already a client of mine. If you're not, then my apologies, but you would have seen us take this trade and simply place an order below the low, stop loss above the high, and the target was here, first target, and this was identified off the back of a level which we saw in the daily time frame. But of course, we had a higher perspective of this currency pair on the monthly and the weekly. Okay, so this is what we're currently in at the moment. We're not in any other trades and currencies, but we are still keeping a beady eye on what is going on. Waiting for Euro GBP, I'll tell you that, like we just mentioned. But certainly, we do want to be looking at taking profits in advance of the election because it could go either way. It really could be a hung parliament. I remember what happened the last hung parliament we had. Pound New Zealand absolutely plummeted through the floor, and that's because a hung parliament, from my limited understanding of politics, doesn't mean that decisions get made it means that decisions don't get made very quickly. When you've got Nick Clegg and David Cameron fumbling around in Parliament, you know that stuff's not going to get done quickly. But anyway, I'll stop inserting political opinion now, I promise. So that's it, really. There's nothing much more to market mapping. Thank you, Steve, for your kind comments, by the way. I mean, there's a module on this in the members area. But hopefully that's helped to debunk a few of the myths when it comes to drawing levels of support and resistance and waiting for the trade to come to you. And, of course, pinpointing trades long in advance of them happening. Okay, and this is something which I really, really want to encourage you all to kind of take away. Start on the monthly, then the weekly, and then the daily, if you're trading the daily time frame. The daily time frame has so many benefits to it. It's unreal. It means that you can just simply set your trades up and walk away and do something else with your time, rather than hunched over a screen, chasing pips and pence. There's a lot of people, what they do when they start trading is they'll start with a relatively small trading account, and they'll think that they could become a full-time trader with a $1,000 trading account, and they'll essentially blow their accounts, because even remember, Warren Buffett makes 20% return roughly every year, which is a fantastic return. People who think they can make that every month in trading, with due respect, I mean, it is very ambitious, and a lot of people who do set these targets like that generally end up getting burned because they overreach themselves, they get greedy, they get desperate, they have an emotional attachment to the outcome of the trade, and that's not a good situation to be in. You should always trade with money you can afford to lose. Worst case scenario, okay? And of course, profitability long-term comes with practice and appreciation for this, but you should never have an emotional attachment to the outcome of a situation, not least a trade, because no matter how good the trade looks, the market will do its thing. The market can be an ass, and it can be a bachelor, and it can be a downright pain in the ass. Anyway, moving back to this, my lecture notes. I just want to really kind of like bring to your attention this. I'm doing this for today only, okay? And this is closed to current clients of mine or past clients of mine, to open for people who want to have the opportunity to see what we do behind closed doors. We've got this ultimate program, which has had very good reviews. Basically, it's a training mentorship program which teaches you how to trade any asset class at any market from as little as 10 minutes a day. We've got lots going on in the members area. We've got webinars, weekly trade ideas, trade hypnosis courses. We've got pattern recognition software, you name it, valued at $1,997. But I'm going to give you, the online price is $252. I'm going to give you access for 1 month for $1 today only, and it closes at midnight tonight. So get access for it for 1 month for $1. It's peanuts, and yeah, take advantage of it. Why not? You've got nothing to lose. Even if you're not satisfied, I'll give you your dollar back. Simple as that. Although we haven't yet had anyone do that yet, touch wood. But what you'll just get access to all of our video tutorials, strategies, market analysis. We've got free traders, combined experience of 40 years between Julian, who's a veteran of the market, Kaylee, and myself. And yeah, wealth programming audio course, trader hypnosis, audio course as well. As I said, pattern recognition software, lifetime support, weekly market analysis. So you're always going to be close to the fire, and you'll be supported every step of the way. And we're going to be launching forums very soon. They're just in the beta testing phase, and we've got hedging strategies coming along. So if you want to take advantage of this, no love lost. If you don't want to, it's fine. Just go to www.thelazytrader.com/forex training, read the T's and C's, buy the ultimate program, use the promo code $1 to reduce that $252 to $1, and you'll get 1 month access for $1. And there you have it. Okay. And yeah, if it's not for you, then fine. If it is for you, then we really look forward to working with you closely over the next year or so. A lot of our clients stay for, between 8 and 12 months. Okay. Anyway, that's it from me. If you want to come on board, then www.thelazytrader.com/forex training. Use the promo code, make a note of it. It's $1 in lowercase, and it's only open till midnight tonight. Okay. Anyone who asks me afterwards won't get it. I'm sorry, but that's the way I'm going to have to run this. Okay. Thank you all very much for your time. And if you've got any questions, do ask me and I'll answer them. Let's have a look here. I've got Joshua. At every entry level, what's the minimum stop loss you recommend? Well, it depends on the size of my activator bar. If it's a price action based setup, if it's supply or demand based setup, then I typically have, if I'm trading on the daily or the weekly, anything between 100 and 200 pips difference between my entry and my stop loss. Okay, but if I'm trading price action, it depends on the size of the bar. Okay, so it's a very open-ended question you've given me. Okay, you're welcome. Have a great day, folks. Hopefully see you on the other side of the wall on Ultimate. If not, then see you again next month. Take care. Have a great day.